Well, good afternoon, everybody. My name is Rich Harvey, CEO of propertybuyer.com.au, and thank you for joining our webinar today. Our very special guest is Dr. Andrew Wilson from My Housing Market, and I'll just introduce Andrew. Andrew has been a property economist for many years, been a keynote presenter for the Committee for Economic Development, been an appointed housing market and expert advisor to the federal government and the Australian Urban Research Infrastructure Network. He's got a PhD in housing market economics, and you'll often see him in his smiling head spouting all sorts of wisdom on your regular TV networks. So without further ado, Andrew, welcome to the webinar today.
Yeah, thanks very much, Rich. And here we are, third weekend in September. Can you believe it?
I reckon. It's
coming. Can I dare say that?
Exactly. Well, look, we've got a range of topics to get through today, and just by way of introduction, and Andrew, you might start to share your screen if you could.
Yep.
We're going to be covering about will interest rates rise and where are they going to end up? We're going to look at fundamental growth drivers and are they changing? What's happening with jobs and migration? Will we go to recession? What's the future directions of the property market? What are the headwinds? What are the tailwinds? And what's the real impact of inflation? And is it really the beast that it's made out to be? So, Andrew, we've got a lot to get through. We're going to be providing a handout after the webinar. So take some notes, Andrew, over to you. And look, can I also encourage everyone during the webinar, if you've got a question, just put it into the Q&A box below, and we will have around 15, 20 minutes of questions at the end. So that'll be a great opportunity for you to ask your hard-hitting questions. But Andrew, I'll hand over to you, please. Thank you.
Thanks very much, Rich. And we have a lot to get through. So I will be speaking quickly, but we will get through it and leave some times for questions. So we're heading for about a 50-minute presentation here. And I will flip through a few of the slides quite quickly and concentrate on the, I guess, the main agenda. But as I said, it is well and truly into spring now, third weekend of September. It is the spring selling season. This weekend in Sydney, we have Super Saturday, which is the Saturday before the NRL Grand Final and, of course, the public holiday. So we will get around 800 auctions coming through. And we've had some good numbers of auctions in the Sydney market over recent weekends. And the Melbourne market's also performing quite well. Notwithstanding all the doom and gloom we've had to suffer. Confidence is low. There's no doubt about that, or lower, and that's a product of higher interest rates. But we'll speak about that in some depth going forward. So thanks for the introduction, Rich. That is my brand, My Housing Market. I work as an independent commentator, providing analysis and data regarding the housing market. And of course, my key saying is we're all about the current state and future prospects of housing markets. And current state is the key phrase there. It is all about looking at real-time insights into the market rather than backward looking, which is what we get with a lot of the data sets and a lot of the commentary in the market. So let's get going. I do have a few qualifications, and I think that's important if you situate yourself as a talking head in any field, and they are qualifications around the topic that I do speak on, and of course that's housing market economics, and those qualifications are also research qualifications. So I have formal research capabilities, so anything I say really has some sort of a basis in research, in formal research. I've also had a significant career as a property economist. My last formal role was as chief economist for the Domain Group, but I've been working as an independent commentator since then, and I have a number of clients, of which Rich is one, and I'm always glad to be involved with Property Buyer. Also, as Rich mentioned, I get my head on the box every now and again and other bits and pieces, and we did a spring preview in the Sydney market a couple of weekends ago. So look out for that, but we're not really here to speak about me. We're here to talk about our housing markets, their current state and future prospects. And of course, they're all our wonderful capital cities there. And home prices are still generally falling. We shouldn't be surprised at that, given how strong they rose last year. And the law of gravity says that what comes up must come down, and come down they are. But early signs of recovery, yes, I am actually saying that word, are now emerging, but I'm not just saying it in some sort of a, would be, could be wishing type of environment. I'm going to support that with some data today, but certainly those early signs are emerging, particularly in the markets, Melbourne and Sydney, that led the charge downwards. And the Sydney market, has grown stronger than any of the other markets through the period. It also has fallen more sharply than any of the other markets, but maybe it's now going to lead its way back into a more positive environment. And we shouldn't really be surprised at housing markets picking up sooner rather than later, because we just have this remarkable economy. Unemployment rates we really have never seen before, certainly monthly unemployment rates we've never seen before. And they're going nowhere really in the shorter term. So everybody who wants a job can get a job, and everybody, it seems, is having serious conversations with their employer to try to get a little bit more money out of them. And I think that's working. I'm not so sure that's a good news story for inflation, but certainly those early signs of recovery are now emerging. When we discuss the housing market, I like to break it down into three principal drivers. Of course, on the demand side, that's people. They've got to live somewhere. And we had borders shut for a couple of years through COVID, but we've opened them up again. And we're welcoming those international new residents into our country. Of course, they've got to live somewhere. And that means more demand for housing in a country where I think we've actually run out of housing, to be quite honest, and just look at those rental numbers to validate that. But migration's been important in our housing markets over the last year, particularly interstate migration, because there's no doubt that that drove very strong growth in Brisbane and southeast Queensland as those COVID refugees headed up from southern states, particularly Melbourne. But that's eased now, and the drive into Brisbane is not as strong as it was, because thankfully, fingers crossed, all those sort of things, we've got COVID behind us now, and we can get back to more of a normalised environment. We certainly hope so. But on the demand, opposite to demand, of course, is supply. We'll have a quick look at home building, and home building certainly, despite the surge last year from the home builder policy from the previous government, home building is certainly back to being at its low levels. We're still well down on our new supply levels compared to 5 or 6 years ago. And of course, that means we're going to struggle to house our residents, and not just our existing residents, but of course also the residents that are coming back into our country in waves. The glue that holds it all together is the economy. And when we talk about housing, we certainly talk about interest rates. And that's been the big story since May, with interest rate rises now over 5 consecutive months. And just a hint from the Reserve Bank governor on Friday, Rich, that he may be starting to think about not increasing rates at the same rate he has been. And maybe there's a bit of an end to that in sight. And Australia is still the lucky country, Rich, because our data, our key data around inflation is better than anybody else. For various reasons, and we'll look at that in a bit more depth. But Andrew, maybe we can.
Quick question, if I may.
Yep.
One of the questions. I mean, you've identified the key things there about people, houses, and economy. But a lot of people have said during COVID, we all fled the cities because we could work remotely. Do you think that trend is going to continue, fleeing the capital cities, or do you think the tide will come back in a bit more, and there might be a different kind of drivers, or are these fundamental drivers are going to continue for the housing market?
I think the work from home environment is here to stay, Rich. But I do think the offers or what big cities offer us in terms of infrastructure and recreation, they're here to stay too. Yep. So it will be more of a work from home environment. Bosses are finding it tough to get people back in 9 to 5. Fair enough. The weekly work routine is different now, and it will be a mix. And it is a brave new world. But I'm not sure we'll be outside our capital cities. We'll still be attracted to them for the usual reasons. But certainly we will be creating those home office environments, but within our capital cities, I think, going forward, Rich.
Okay.
So the economy and interest rates, of course, interest rates do generate house price growth. Higher rates, lower prices. Lower rates, higher prices. But the trend is interesting, Rich, because we tend to have a stabilising and an easing in prices during periods of higher rates. But when we get lower rates, we take off and we get very strong growth. And that's because buyers and sellers tend to sit on their hands during times of higher interest rates. And of course, that creates pent-up demand. And as soon as we get the relief valve involved and lower rates, we get significant rises in prices. And that's the general, I guess, outlook, or in terms of when we do get a cut to rates, all that pent-up demand that's been created now will be released, and we will get a bounce back in prices growth. But we've got a lot of water to go under the bridge until that happens. Now, the Reserve Bank sets interest rates for everybody. So the whole country has to suffer higher rates or enjoy lower rates. And that has an impact on house prices, of course, because if you have a higher interest rate with a given income, you can't borrow as much. And of course, your confidence is affected. But if you have, so therefore prices have downward pressure. But if you have lower interest rates, you can actually borrow more with a given income. And that means that puts upward pressure on prices. So, but the rate of growth, notwithstanding interest rates, is all about local factors. And those local factors are, we've already alluded to that, principally supply and demand in terms of migration as a short-term demand driver, and of course the level of home building. So let's have a look at what interest rates have done over the journey here, and you can see that roller coaster ride in interest rates, Rich. We're up with, these are mortgage rates. They're as high as 10% way back in 2007.
Can you believe it? I know, amazing.
I know. We're sort of whinging about 5 at the moment, so we've got a bit of a way to catch up to that, but still 10% interest rates were in the environment of a booming economy, fantastic economy then, but we had way too much demand, not enough supply, and inflation was rising. The Reserve Bank was increasing rates, and it just about started to work way back then in 2007 when the economy was coming off the boil and booming house prices had started to ease. But along came the GFC, which was the global financial crisis, international global downturn. Reserve Bank moved quickly into reverse gear, cutting rates because unemployment increased. It was an international economic downturn. Our mortgage rates fell way down to under 6% then. But Australia, unlike the rest of the world, was saved by mining boom number 2. Thank you, China. Exports of iron ore and coal gave us that economic upturn. And again, we had high inflation or higher inflation. The Reserve Bank stepped in with pushing up interest rates to take the heat out of the economy. It ended the mining boom, or the mining boom came to an end. And that meant that we joined the rest of the world with this conundrum that we couldn't cut rates to the point where it was reinflating economies. So down and down our interest rates went until we got to official rates at just about 0. Our mortgage rates at 4.5%. And then, of course, along came COVID, and all bets were off in terms of driving the usual system through what was happening in inflation. We cut our rates to 0 as a result of inflation, of COVID. But, there's no such thing, I guess, as a free lunch. We got a lot of free lunches through COVID with government handouts and 0 interest rates. But now we have to pay it back. We were paid forward through COVID. Now we're paying it back as a result of inflation. And I guess in hindsight, Rich, it was easy to see that was going to occur. It did. And those higher rates now are about, I guess, paying back all that we had paid forward, because we just didn't have the supply capacity to pay for all that demand, or to cover all that demand. And that's meant higher prices, inflation. And once that inflation genie gets out of the bottle, Rich, it's very hard to stop. And we are in a better position than most at the moment, but there are, certainly questionable times ahead as to the future. And particularly the US is having a much tougher time controlling inflation for various reasons, which we'll have a quick look at shortly. But you can see how house prices, as I suggested, respond to interest rates. Higher interest rates, easing of house prices, lower interest rates, higher house prices, and then booming house prices. But regardless of that relationship, as I mentioned before, you can see that different markets respond differently. Melbourne and Sydney had some tremendous price growth through the period of 2014 to 2017 as a result of lower rates. Sydney was particularly driven by investors. They had an apartment boom during that period, and Melbourne was particularly driven by record levels of migration. But along came COVID. You can see that up and down effect through the lockdowns. But lockdowns were supposed to crash our housing markets, Rich. Again, more predictions of doom and gloom that proved to be wrong. Yeah. In fact, all that ended up being was a blockage to pretty keen buyers trying to get rid of that pent-up demand. As
are you telling me that bank economists get it wrong? Is that what you're trying to say?
I don't know what's going on here, mate, but they don't have a good record, do they? No. I got a feeling that a few of those forecasts of a few months ago will start to be revised pretty soon. We've already seen the sort of quasi forecasts that the Reserve Bank make are starting to go look a lot better than they did a few months ago. But
I'd love to see them take on the one that Roy Robinson, remember, and he challenged Steve Keen to
walk them out.
Oscar said I was hopelessly wrong on interest rates and/or the property market.
Yeah, but they still get a gig. These guys and gals, they're still around. All the ones that have made those silly predictions that were wrong. Yeah. They still get listened to, but you scratch your head and you wonder what's going on. But certainly the outlook is a lot brighter now, Rich, than it has been.
So
and even
maybe just unpack for us in the next couple of slides what you've got, because I know you've got some really good detail about the economy and interest rates and inflation coming up.
Well, we can see the differentials there in terms of house price growth and what happens with interest rates. And that's important to understand when we're talking about national house prices. We really got to consider that we might have weakening markets in Melbourne and Sydney, but they take up the majority of the national house price, wherever the national house is. I don't know where that is, but you can have other markets performing a lot better if Melbourne and Sydney are going down. And as I said, the Melbourne and Sydney markets are now, and we'll see in more depth shortly, are now going through a revival stage. And the Reserve Bank has said that they reckon interest rates, this is the latest statement, will peak at around about 7.75%. They're certainly saying that the outlook is more uncertain or is uncertain. So, they're relying on the data that comes through. The next critical data will be the inflation data for the September quarter, which will be released in about a month. And this time they're going to have some monthly data, Rich, which is going to be a lot more helpful to guide them in their judgments. But we'll certainly have a better, I think, September quarter for inflation, mainly because the price of oil has fallen, and we'll look at that shortly. And that's the issue, is the Reserve Bank's waiting for the data to come through. Australia was a little hamstrung because its data was quarterly, not monthly, as other countries have. But now we have monthly data, so hopefully that'll improve the real-time aspect of decision making. And we know that the price of oil has fallen. Also, house building costs are starting to ease as well. So that'll mean likely a lower inflation rate over the September quarter, which means perhaps that's validating what the Reserve Bank governor has been saying recently about maybe not having to increase rates as quickly or to the level that they thought previously. So maybe that 7.75% prediction is a bit on the high side, but we'll wait and see with bated breath, of course, Rich. But we still have some good offsets to higher rates. Rates are still at those near record lows. We compared that 10% rate back in 2007 mortgage rate. Rich, we're still well below that at around 5 at the moment. Wages are rising, and they're rising strongly in some areas. We've had recent government handouts through the election campaigns. Of course, we're all enjoying those very high house prices. I'm not sure if high is the right word, but we've certainly had a big lift in our asset values recently through the booms of the last year or so. So that makes our household budgetary position strong. Saving levels are coming back as, of course, real wages are falling. So we're delving into our savings, but they're still at reasonably high levels, Rich, because we saved assiduously through the COVID period. We had that 3% buffer that the banks put on. They were sort of criticised for that when they did put it on, but it's actually starting to prove worthwhile. That little bit of backup for your interest rate, that 3% that you had to be able to cover with your repayments. So that's now coming in handy at the moment. Of course, we have the remarkable full economy or full employment economy at the moment with a record low unemployment rate. And when we look at the big picture, Rich, only 15% of all households are exposed with higher mortgage balances to interest rates. In fact, half of all households, Rich, actually own their own property with no mortgage. So I'm not sure, the issues with them are not as significant to those that have a higher mortgage balance. And of course, the housing market will take advantage of extra demand through migrants. First home buyers have an extension to the first home buyer scheme. Investors will be taking advantage of those skyrocketing rents, which are pushing up yields. Downsizers also had some benefits from recent policy announcements. Our rental market's just about as tight as it's ever been, Rich.
I've never seen it, Andrew, this tight. Brisbane vacancy rate 0.7 and declining. And it's just, I've never seen it so low. It's going to be a bit like, I don't know what your thoughts are, whether we're ever going to have the same situation as Ireland, but I can foresee if, Queensland land taxes and all that sort of stupid other tax grabs keep coming in, it's just going to exacerbate the situation. So I really feel for those in the rental market trying to find a property.
And also it's going to really hurt inflation because, landlords will just cover the increased taxes and homeowners with increased wages or increased prices. So, and prices by that I mean rents. But very tight rental market and low new home building also, so we can't keep up with demand with new homes. The jobless rate 3.5%, great result there. Look how low that jobless rate is. Even back when we were increasing rates before in our booming economy, the unemployment rate was at 4.9%. So tremendous result there. A lot of it's the participation rate. This makes it even stronger because we're dragging people out of the population who aren't really interested in working. I'm talking about retirees and self-employed. They're now joining the workforce in record numbers because there's so many opportunities out there. So it's really, this isn't a result of a low participation rate. We've still got a high participation rate. I'm not sure we can go much lower than in the mid threes. Maybe we'll get down to the low threes. But regardless, anybody who wants a job can get a job, and everybody's putting their hand up because they're in such high demand for a wage rise. Jobs grew again over August, no surprise there, after a fall back in July due to a winter hiatus period. The labour force is still growing, of course. It's not growing as strong as it did before COVID, Rich, and that's because we don't have the migrants. And it's interesting when we look at COVID or the pre-COVID period to the post-COVID period, or the period since COVID, the difference in the number of people in our workforce is basically the difference between our borders being locked during COVID. And we've really missed out on those migrant workers. And that's why we've got such low unemployment, is because we just didn't have, and that's the difference, is 300,000 workers we didn't get or haven't had as a result of migration. But that's changing now. So hopefully that'll alleviate some of our issues in the employment market. Wages aren't growing. This is sort of a good news, bad story. Of course, you want wages growing, but unfortunately, higher wages tend to fuel inflation. So Australia's well positioned. We have a pretty sticky wage setting environment in Australia. We don't respond as quickly as other countries such as the US to changes in prices. We have to wait a year or sometimes 2 years to have our wage reviews. And of course, we have enterprise bargaining, which basically says we don't get pay rises without some sign of a productivity increase. So that's working in our benefit, although it certainly means that real wages are falling. Underlying inflation, 4.9%, and it's underlying inflation that the Reserve Bank looks at. Its target is 2 to 3%. But the spike in headline inflation has really been about oil prices and house building. We can see there that, and of course, we had a surge in house building, Rich, as a result of home builder. We didn't have enough subcontractors or building workers and didn't have enough materials to cover that surge last year. So house building costs have gone through the roof. But some good signs, Rich, we're just starting to see the rate of growth of house building costs starting to ease. Still certainly high. But of course, we've got to remember that inflation's all about the rate of growth, not the level of prices. It's about the rate of growth. So we want to see that rate of growth starting to ease. We're seeing that with house building costs, which is good news, which was always going to happen once we absorbed all that demand that came through. But the back end is following that surge in new house building last year. We're not seeing anything like that now. We're back to those very low levels of new building. So, where do the migrants live? And this again puts up.
Well, that's going to be a question I'd want to discuss more with you. But the Home Office apparently have allocated about another $15 million to try and process all the applications. But it's still a basket case. They're honestly trying to process, but it's not fast enough. But they're trying to unplug that gap. But once they start coming, mate, next year, I can tell you, a lot of these numbers in your charts will be different in terms of, it's going to be great for investors, but tough being a renter, and great if you're a landlord.
Absolutely. Yes, we're already under supply, and we've got to find another 200, accommodation for another 2, maybe 300,000 people coming through. Where are they going to live? This is a real.
I'll tell you something else that's interesting. I spoke to one of my contacts who's a migration agent, and in the stats, the sponsored migrants that are sponsored are not picked up in some of those figures, right? So I think the figures are going to be higher than 200,000. Could be another 60 to 80,000 above those numbers are actually going to be coming through as well.
And where are they going to live?
Exactly. Your place? You got a room? Yeah.
No, mate, sorry. We'll pull up here. But another positive sign is, although rents are still rising, maybe the trend of growth is just starting to ease with home rents. Now, these are home rents. This is units and houses. But the interesting conundrum we're seeing is that house rents are starting to level off in some capitals, Rich, but I think that's only because they're so expensive, people can't afford them anymore. And they're now shifting across to units. Now, units are growing, continuing to grow strongly. And I think that's an affordability choice that we're seeing, that house rents are so high that people are having to choose units. Even people with families, larger families, are having to choose units because they can't afford houses. But nonetheless, there's some early signs that that's starting to level off. But gee, I would want to, Rich, because we've been growing at better than 20% a year.
I just did the numbers. It was 20%, $440, $90 increase is 20%. And it's not slowing down, right?
You can't keep that going. And, you know, unfortunately, it works its way into inflation because people go for job rises to cover the higher rents. Yeah. So, you know, this is an undersupplied market, but some early signs maybe that the drivers of inflation might be easing in this country. Real wages are down. That's going to drive, you know, demand for for more income. But our fall in real wages is the pain, if you understand what I mean. But as I said before, we have got plenty of offsets to cover that fall in real wages in the shorter term, which is a positive. Now, the price of oil has now fallen. It's actually even lower than that. You can see it was record levels earlier this year. And we know that with the price of petrol was around 220, 230 in some states, Rich, but it's now fallen now. We can see Bowser prices per litre of around $1.50 and lower. So you can never bank on where the price of oil is going because it's run by a cartel, but certainly the trend is down. And that will see likely a lower inflation rate for Australia when we get the data for the September quarter, which will take some heat out of the action on higher interest rates. Unfortunately, we're still spending like drunken sailors, and there's the retail sales figures. Look how high they are compared to pre-COVID. And that's the whole story of inflation. You can see we were tracking at around about 27 billion per month retail sales, and now we're still up at around over $30 billion per month in retail sales. It had started to ease, but we had another pickup over July, which is the latest data. So hopefully we can see that retail spending numbers start to ease a bit, because the more we spend, the harder it is for businesses to respond to all that demand. And that means you've got to wait and prices go up because all the supply lines are creating, you know, this log jam. So we're still, you know, but this is why our economy is booming, Rich, because we're spending, we've got all this capacity, we're having a great time, we're traveling again, we're getting higher wages, but unfortunately it's working its way into inflation. Australia had a good result for its GDP numbers over the June quarter, up by 0.9%. And that's actually quite a good result. Following that 0.8%, but and just the share market's actually been surprisingly steady given higher rates. We've got a big decision tomorrow in the US, Rich, out of the US. They may actually increase rates by 1% tomorrow. They've got a big problem with inflation. They had some, the headline number was lower over August for the US, but their underlying inflation rate, which takes out the price of oil, increased to another record level. So they're going to have to do something there, and he's going to have to do something. He's going to have to do something. And I reckon they'll go 1%. They've been going 0.75. I reckon they'll go 1%. You know, so keep your eye on that. And that's not good news for us, because in a way he's just now pushing them into a fair income recession. They're in a recession already in terms of 2 quarters of negative growth, but they're going to have to start easing demand seriously in the US. But we are in a significantly better position. Our dollar's lower, but that's probably good news in a way, because it helps our export industries. The Reserve Bank won't be too unhappy about that lower dollar. And part of that GDP number that was so strong was our terms of trade. Our terms of trade is fabulous at the moment, and that's because we're exporting. A lot of our resources are getting higher levels of demand, actual volumes, but prices are also high too. So that contributed to our big GDP number. And no surprise, the other big contribution was from spending, you know. So it's all good, but the dollar is a little lower now, but the Australian dollar is high. So let's have a quick look to finish our economic insights into how Australia compares with the rest of the world in terms of, I'll just get this screen working a bit better, of our wages. You can see the big difference in wages growth there, Rich. The US and the UK have double the wages growth that we have, and they have a much bigger inflation problem. Our growth is better really than everywhere else. Negative growth in New Zealand, US and the UK. We're still chugging along at quite a nice number there, the quarterly growth rate. Our headline inflation rate is well below the rest, everybody else. So it correlates with those wage increases being lower than everywhere else. The UK's, really in some strife there, in terms of their inflation. They're predicting inflation to maybe even double from where it is in the UK and certainly the US. And these are headline rates, not underlying rates, but we're in a much better position compared to the rest. And our official interest rates are lower everywhere. And it won't be long before the UK is up again. And as I said, the US might be up at 3.5% tomorrow. So interest rates are tracking better than the rest. So that's our sort of economic overview. Just quickly, Rich, I'm going to go very fast now, mate. Don't you worry.
It's all good. Don't worry. All good. Yeah.
So we'll look firstly, we mentioned those other key drivers, migration. We've spoken about the flood of migrants to enter the country. Where are they going to live? They're not living with me. And we can see how migration fell dramatically through COVID, particularly in New South Wales and Victoria. That will reverse quickly because they are the go-to states for international migrants, particularly Melbourne and Sydney as the go-to cities. So expect that to be a driving force for housing markets as migration recovers. You can see the gold cycle there is in Queensland, and that's all about the COVID refugees coming out of Melbourne and out of Sydney during lockdowns, particularly out of Melbourne, and that really did bolster the Brisbane housing market. But those that drive has finished now. Now, home building, we can see there the latest home building data was flat for housing and a big fall in unit developments over August, which again is over July, which is a sobering result. The future is to a large degree going to be apartments, particularly in our major cities, and we're just not building enough properties at the moment. And even though we've had a reasonable outcome for units this year so far, they were now falling away quite sharply. If we look at the big picture there, Rich, you can see how much lower we are now in terms of where we were back in 2015. This is the underlying trend for annual housing approvals, dwelling approvals.
Can I just stop you? One quick question around this. Let you take a sip of water because you're talking flat out. It's awesome. Between sort of 2017, when I think it was when APRA started to bring in those controls, do you think is that the main reason for the dip between halfway through 2017 to the drop in 2019? What was the main reason we had building approvals drop off?
Well, firstly, we had a boom, right? So there was a recovery from that. But absolutely, Rich, it was the credit squeeze that was put on not just investors, but also developers. And we continue to penalise particularly international developers and investors for coming into the country. Now, they can't live here. They can only develop here. So all they're doing is providing houses for those that have the right to live in Australia. And yet they're still penalised from doing that. I think it's just a cheap cash grab from short-sighted state governments particularly. But we're paying the price now. You can see the blip upwards there during Home Builder last year, but now we're back to where we were prior to Home Builder. And you can see it was travelling southwards quickly through that period. And that momentum was certainly driven by the credit squeeze that was placed on investors and developers through that period. It's tough enough as it is with all the barriers to development in this country. Local political issues, not in my backyard, all the green tape and the red tape and the black tape that is around new development. And I'm not just talking high rise here, it's also medium density is tough to get off the ground. And yet we don't have enough housing. And yet we have rents rising by 20% a year. We're not building enough. They all recognise these issues. Governments recognise it. And all they do is create short-term Band-Aid effects to try to cover it. But if you're not building enough houses, Rich, people have to find somewhere to live. So, we're going to have share houses, and God forbid we're going to head towards, I hope we don't, what happens on the west coast of America where people live on the streets, in large numbers. But we have to be aware of this and start to build more houses, mate. Come on.
100%. Yep.
More houses, and units. So that's the issue with, and you can see the big difference here in development between there, how units have collapsed. Unit development has collapsed since the peak in 2015 and still heading south now. and this is houses. We can see we had a big blip through houses as a result of home builder, but that's now started to flatten out and is now beneath, the trend is now beneath the peaks prior to the home builder. So we'll just have a quick look. No surprise that home borrowing levels have fallen away. That's about affordability to a large degree, where we've got to the point where we can't borrow anymore. So home lending because of high house prices, but a lot of that also reflects the COVID period, and the value of home lending is still high historically, but it had to come back as the boom has ended, no surprise. And we can see there that all buyer sectors have fallen away over July in terms of that adjustment to the market. Investors, although they led the charge downwards over the month of July, have still been the big performers over the past year. So investors have certainly come back into the market, and a lot of that is an easing of lending restrictions on them. And they're also, of course, attracted not only by capital growth, but skyrocketing rents. First home buy, the market share now is starting to even up. It's starting to look a lot more normal. The share of the total lending market between first home buyers, investors, and owner occupiers. First home buyers probably have stood up a bit more than one would have expected with high prices, and investors are still catching up to the long-term trend, which just sort of reinforced what you were saying before, Rich, about the taking of investors out of the market through those policies back in 2015-16. No surprise, refinancing is rising. People are worried about higher rates, so they're rushing to refinance. Still rising. I'm not sure that's a strategy that holds water over the longer term, but nonetheless, people have individual circumstances. And the interesting thing is now that refinancing compared to the total home loan market is at a near record level of 45%. So again, no surprise, people are concerned about the outlook for interest rates. But unfortunately, those fixed interest rates now are at very high levels from those low levels a year ago. So the question is, because banks don't really have any incentive because they're not restricted as they are with variable rates with what happens with the Reserve Bank. They can follow their own particular strategies in terms of fixed rate policies, and they're quite high at the moment, Rich, and will likely to continue to rise those fixed term rates. This is my affordability index. This measures the proportion of the average income that you pay in your average repayment for the average loan. And you can see that the higher it is, the less affordable the property is, because you're actually paying a higher proportion of your income for your repayment. That's the average line there over the longer term back to 2010. Once we moved above the average line, it started to mean that affordability was dragging buyers out of the market. And you can see how home lending has fallen as a result of that. A bit of a blip in the middle of that trend because of COVID lockdowns, but it's just the natural stabilizer in our housing markets. 80-20 LVRs, banks say that you can do, and you can only repay 25% of your mortgage, of your income on your mortgage repayment. So that means once it gets to a certain level, house prices, unless you're getting a lower interest rate or a significantly higher income, you are restricted from being in the market. So let's have a quick look at house prices. This is the latest data, quarterly data, which of course is formal quarters, which is the June quarter. So it is a bit backward looking. You can see Sydney and Melbourne heading downwards, Brisbane, Adelaide and Perth still upwards, but annual prices growth over the past year has still been strong, particularly in Brisbane and Adelaide, but we will await the September quarter data, which will be coming out in 2 weeks, Rich. So look out for that, and it will tell a different story. No surprise, Sydney has still the highest median house prices over the June quarter. That won't change for both houses and units, and well ahead of all the other capital cities. You can see that it's interesting that Brisbane has broken free from its relationship with Adelaide. We usually saw Adelaide and Brisbane track each other pretty closely in median house prices, but that remarkable boom last year has certainly elevated Brisbane above Adelaide. Rental markets, we've already spoken about rental markets. We have a chronic shortage of house vacancies. It is part of what we discussed, Rich, that demand for larger houses from work from home, and vacancies that were high in inner city Melbourne and Sydney for units, particularly CBD Melbourne, have now fallen sharply, and that's because that's rebalancing that market. Sydney rents, as with house prices, are still higher than everywhere else for both houses and units. Look at that, $650 a week now asking rent in Sydney. It seems like just yesterday it was $500 and falling. and $550 for a unit rent, median unit rent, and rising sharply. Annual rents, look at that, 22.2% over the past year. Rents have risen in Sydney, up strongly everywhere else. And annual unit rents in Sydney are up around 16% as well. So these are remarkable data points in terms of rental growth. And no surprise that vacancy rates are low everywhere for houses and falling. And look how low they are now in Sydney. That's a dramatic improvement in vacancy rates for units in Sydney. Unit rents in Sydney are rising sharply at the moment, and vacancy rates that, there's queues of looking for units now to rent in Sydney, whereas, we had a surf at clearly even just nine months ago. Melbourne vacancy rates have fallen sharply, but not down to the level yet of Sydney, but still falling for units, those vacancy rates. So let's have a look at the latest prices. These are monthly prices, Rich. This is interesting because this shows you that the latest monthly data is showing, even though prices are falling still in Sydney and Melbourne, they're not falling at the same rate they were before. So there is a clear improvement in the market there. I think that the Melbourne market might bottom out by the end of the year. And I also think there's a chance the Sydney market might also be under 1% declines by the end of the year. These are monthly declines. Certainly other factors are pointing in that direction. Brisbane's catching up on the negative side now from all the positives it had last year. No surprise there. And Adelaide and Perth are tracking at around about the neutral rate. But certainly some positive signs there that the rate of declines in house prices in Sydney and Melbourne are now declining. And this is real-time data. And we await, what's to come going forward. So prices still falling, but not at the rate they were. So signalling that we may be reaching for the bottom in those markets, particularly the Melbourne market, Rich. And as I said, that will be a big beneficiary of migrants when migrants resume. Over the year to date to August, Sydney down 7.3, Melbourne 5.1, but all the other capital city markets are still higher this year so far. And it's only really the Melbourne and Sydney market. So the national market down 2.3%. Average days on market is also falling, Rich. So another positive sign. This is the monthly duration for selling a house up to the 11th. And you can see that compared to the previous month in Sydney, it's now lower. In Melbourne, it's now fallen over 2 consecutive months, the duration it takes to sell a house. In Melbourne, it is given, and these correlate with the data we just showed on house prices, Rich. It's a similar scenario. Of course, it's taking longer now to sell in Brisbane. We knew that. And Adelaide and Perth is reasonably level. But in absolute terms, it tells you which markets, the performance of markets. Now, these are still well above where they were earlier in the year, Rich, how long it took to sell a house. But we're all about improvement at the moment. And it's certainly showing an improvement in days on market. And this is a full month's worth of data compared to the previous month, that there's an improvement coming through there. So last weekend, auction markets are a key forward indicator of what's happening in our housing market. You can see clearance rates track house prices in Sydney, no surprise there. And similarly in Melbourne, house prices and clearance rates track each other. So look out for my clearance rates that come out every Saturday night and my full national report on Sundays. You can see this is last weekend's data. Some really interesting results here, Rich. The weekend before in Sydney, we had a massive 67.2% clearance rate, which was looked a little bit out of sync with the low 60s that we had been getting. But last weekend, we had another big surge in auction numbers, and we got a consolidation of a mid 60% clearance rate. I think this is very positive news.
A lot of people out there are thinking it's a buyer's market, but I've got to say, the results that we're seeing on the ground at the individual property auctions is that the high quality properties are still selling well. They're still not selling at the peak, but they're selling a little bit below their peak, not 20% or 15% below the peak. So it goes to show that, quality properties are still holding their value well.
And I think the benchmark here we should point out to everybody, Rich, is that 65% is probably around about the midpoint of the market. In other words, that's the point at which buyers and sellers are reasonably overall balanced. So you're not seeing higher prices or lower prices at around about a 65% clearance rate. Once you move above 65%, get towards 70%, you're getting higher prices because there's more buyers than sellers. And when you're below that 65%, 60 in the 50s, you've got more sellers than buyers. So this is now heading, and this is, if you can see that the trend there is clearly upwards in Sydney. And these are very positive results. Now, early spring is usually the best time of the market for sellers, and later spring is best for buyers because we have more stock around. Now, we are in the middle of an adjustment period in the cycle, so it'll be interesting to see how that pans out towards the end of the year. But at the moment, we're seeing what you would describe as a normal rebounding spring selling season. Early spring, good news for sellers. Later spring, better news for buyers. And these numbers are very good. Now, this weekend in Sydney will be Super Saturday. We'll likely get around 800 plus auctions because it's the weekend before the public holiday and the NRL Grand Final. So that'll be a big challenge for the market to see whether it can absorb, another 200 properties that will come are likely to be listed. But I tell you, Rich, if they can get another mid 60% clearance rate, I'll become a lot more confident about the outlook for the Sydney market. Yeah. Melbourne had its Super Saturday on the weekend. Of course, the AFL Grand Final is this coming weekend. So there was nearly 900 auctions in Melbourne, a little bit down on some previous years' Super Saturdays. But again, the Melbourne market's really been the great survivor through this period, given how strongly it grew last year. It's been tracking in the low mid 60s really through most of the past few months, despite higher numbers of listings coming through. So another very solid result there for Melbourne. In fact, its clearance rate was higher. Brisbane ticked up with a significant jump in listings in Brisbane. Adelaide, correlating the prices data and the days on market data we've just looked at previously, Adelaide is clearly the strongest market, another big clearance rate there in Adelaide. And Canberra is the underperformer. It had a very strong period last year, and it's certainly holding or I guess catching its breath now, following very strong results last year. So you can see the trend for Sydney is clearly upwards there over the weekend, and that over the previous weekends, and that Melbourne has been holding its own, very resilient market in those mid 60s over the past couple of months. Brisbane has picked up its clearance rate so far this month compared to last month. Adelaide steady in the 80% results, tremendous outcomes for Adelaide. And Canberra, as we mentioned, certainly well below where it was a year ago. So look out for those auction results on LinkedIn. Saturday nights, I send out the snapshot of the results around about 6:20. And first thing Sunday morning, we have the full national report. So let's put it all together now, Rich. We're coming to the close on time at last.
Mate, you're a legend. And just while you're doing the summary, I can see some of you have put some questions there. Please just jot your questions down, and we will have enough time to get through all your questions. So thanks, Andrew.
So key inflation drivers, have we described in some depth, Rich, are easing. They may now peak lower and earlier than predicted. And don't just believe me, the Reserve Bank governor is saying similar things last week. And of course, our booming national economy is well positioned to absorb higher rates, which we've been doing okay, certainly better than others up to this point in time. No doubt that prices growth has eased through 2022. Those rising affordability barriers, we showed you the affordability index from those booming markets last year, have sidelined buyers. And of course, higher interest rates constrain prices growth, and they impact confidence in the shorter term, Rich. We know that. All those crazy headlines of doom and gloom, they work their way into the mindset of buyers and sellers. They sit on their hands. But you know what that does, Rich? It creates pent-up demand. So we saw all that pent-up demand created and released through COVID, and look at the prices growth we got as a result of that. So pent-up demand is being created now. And once we get back to a more balanced environment in terms of our interest rate outlook, that pent-up demand will be released as usual. An underlying demand will remain above supply. We've said that. Higher levels of migration, lower levels of building means that underlying demand remains above supply. COVID outbreaks, we don't even really have to talk about that anymore, do we, Rich? It certainly proved at the time to be a temporary short-term interference to overall robust housing market.
I'm just pleased we don't live in Shanghai or one of the Chinese cities that keeps getting locked down, mate. So.
Well, hey, mate, we did so well compared to the rest of the world during COVID, didn't we? And now we're doing great. Well, not great, but we're doing better than others in terms of our inflationary position to this point of time. And it's always, clever to be, accurate in hindsight, but I guess to some degree that's what we're doing. Certainly the short-term outlook is for easing house prices driven by the usual rising interest rates fear factor. So we had FOMO driving the market last year, fear of missing out. And now we've got phobia, which I call phobia, which is fear of being involved. And that is the real cycle. We go from phobia to FOMO to phobia to FOMO, depending on rates. But certainly early prices are emerging. And I put together, I think, a reasonable case to justify that statement, Rich, that recent price declines may be easing sooner than predicted. And we're going to look at the outlook now just to finish off to see what we've actually achieved over the last 4 years. So house price predictions. This is the long-term chart of Australia's capital city or aggregated capital city house prices. So this is the national house price based on all the capital cities and weighted for, obviously, the number of sales, which obviously means it's mostly Melbourne and Sydney. But you can see since 1987, we've only had 3 years where house prices have actually fallen, Rich. And this is measured from December quarter to December quarter. And the worst we had was in 2018, which was during that period we've already discussed, where we had this credit squeeze on investors and developers. But that was 5.5% decline, and that's our record. So we've only had 3 years of house price growth. Now these are annual December quarter to December quarter results, and it's official ABS data. You can see behind each of those falls has been remarkable increases in house prices. So these are my forecasts for this year. I think overall Sydney will be down by 9%, Melbourne 6%. The other capital cities will all be above the line. And I think national house prices will fall by 4% this year, which again won't be will be similar to what we saw in those other periods of declines. However, if we go back over the past 4 years, Rich, this is what happened in 2019, which was a recovery year. This is what happened in 2020, which was a COVID year. This is what happened last year. Wow. Wow. This is what happened last year, mate. And we know I've already predicted what's going to happen this year. And if we factor those predictions into what's happened the last 3 years, this is where we all end up. And that's our outcome over the past 4 years. So Brisbane and Adelaide will still be up 40% plus over the past 4 years. That's an average of 10% per year, Rich. And even with those declines in Sydney and Melbourne, Sydney will be up by 34%, which is an average of 8% per year, and starting to look like picking up into next year. And Melbourne up by 24%, which is an underperformance. We know Perth's had issues with the end of their mining boom, but that's an underperformance by Melbourne, but averaging 8% per year. But as I've said, I think Melbourne will be a big beneficiary of migration as it comes into that market. The Melbourne market has been remarkably resilient this year on auction clearance rates. Its days on markets are improving, and its monthly house price figures are certainly improving as well. So that's my story. And what I've tried to do there, Rich, is offset that misinformation and ignorance clearly remain the curse of Australian housing markets, except for those that rationalise and act on the fear it generates. It's generating plenty of fear at the moment, but I think we've come out with a pretty rational view of the situation. Of course, a wise old man who was a president of the United States at the time, but he didn't write this, someone else wrote it for him, no surprise. He said there is nothing to fear but fear itself, and you couldn't be more right when you're talking about the Australian housing market, could you? And that's what history obviously continues to validate. So there are our capital city markets, and certainly moderating prices this year are set to steady overall next year in 2023. So thank you very much for your attention, everyone, and the opportunity to speak, Rich. And I think I've finished just about 60 seconds too late.
Mate, you are just amazing. Thank you for ripping through it, which gives us some time to just elaborate and just banter a bit too with some questions, Andrew. So firstly, say thank you for those comments. Look, I'll just make a couple of comments about the fear factor. I think it was inspired by you. I heard you speak about phobia the other day, and I came up with a whole bunch. I came up with 10 other acronyms. So I've actually written an article, and I think I've included your one in that. So thank you for the inspiration. Talk about fear of renting forever or fear of selling agents. So we've come up with a whole bunch, but I'll share that with everyone online as well to have a bit of a laugh about. A couple of questions. So Damien's asking, could you please elaborate on your comment re inflation along the lines of inflation not being the change in prices, more so the rate of growth? What did you mean by that?
Well, say we have a commodity, right? Now, the Reserve Bank sets its inflation target is 2 to 3%. So it's happy to see prices growing at around 2 to 3% per year, and that's underlying inflation. So it takes out sort of volatile items such as food and fuel that can change quickly due to more localized factors. So they're interested in the underlying sort of price noise in an economy, and they feel 2 to 3% represents something that's reasonably stable. And something that economists and businesses can work around. Well, businesses can work around and governments can work around in terms of their forward planning. So what we're seeing now is inflation's rising at 6%. So that means the price of a good typically is rising by 6% a year. That's headline inflation compared to, well, let's talk about underlying inflation is rising by 4.9% compared to 2 to 3%. Which is the target range. So they want to get it back so it's still growing, but it's only growing at 2.3%. So the actual price of an item is not the relevance here, it's how quickly it's growing. So it's okay to grow by 2 to 3%, but it can't grow by more than that, because then it creates this issue where people need to cover the increase in costs, not the actual costs, but the increase in costs. So they go to the boss and they say, I need 6% wage rise, mate. And the boss says, holy moly. And they say, well, if you don't give it to me, I'm going somewhere else. So they have to have the people obviously working for them to be able to manufacture their product, to make a profit. So all they can do is say, okay, well, I've got to put up my prices by 6%. So they put up their prices by 6%. And then it comes back to the worker who says, holy cow, my prices have just gone up 6%. Sorry, I need another pay rise. And on we go. And this is what the policymakers are trying to avoid, because this then gets a little out of control. Because people are chasing wages, are chasing prices, are chasing wages, and that's a cost wage spiral inflation environment. So it is about the increase, not so when we look at the factors that are driving inflation, they're still increasing. Price of oil is increasing, price of house building is increasing, rents are increasing, but as long as they're starting to increase at a lower rate over the quarter compared to the previous quarter and compared to the same quarter the previous year, you then get the position where there's not that same drive for that increase in incomes to cover the increase in prices.
Yep, great. Okay, thank you. I'll have a crack at the next one here. Damien's asking, explain why the lower Australian dollar value isn't such a bad thing for exports. Fairly simple, Damien. It just means that the price of the goods and services that we're selling to our trading nations is cheaper, and therefore they can afford to buy more of them. So we're more competitive. If we have a higher Australian dollar, the price of our goods and services is higher, and therefore those other countries may look elsewhere and not buy as much of our products. So lower price, low Australian dollar lowers our prices, better exchange rate, better competitive advantage. Peter is asking, Andrew and Rich, what's your view of the proposed new land tax rules for Queensland? Seems it will work against increasing development. Well, I'll pitch in first, Andrew, and you add yours, but I would say it's an absolute stupid, idiotic policy. I think it's tantamount to double taxation by the fact that the Queensland government can ask an investor if they have properties in other states and then use that threshold to then count toward the value of properties you own in Queensland and therefore tax you from a zero threshold. I think it's just going to simply work against disincentivising investors to invest in Queensland. And I think it will mean that Queensland landlords will simply pass on that tax increase through higher rents. So I think it'll be a short-lived tax, in my view. It'll be a bit like the vendor tax that Michael Egan brought in back in, when was it, Andrew, 2010 or something? Yeah. But, I would love to see, you being an economist, I want to see the cost-benefit analysis on this policy. What have they done to say, hey, it's going to provide a net benefit to the economy? What are your views, Andrew?
Well, I think that we need to look at the government's balance sheets, because I think this is obviously an issue to do with, them trying to increase their revenue, and perhaps they're in a position where they need to increase their revenue. But the big picture costs will be, obviously we're in an environment, where we have a shortage of rental properties and a shortage of labour. So any increase in costs, a worker can offset that by asking for higher wages, and a landlord can offset it by asking for higher rent. Now, there's nothing to stop particularly in this environment where we've got governments, which is a little scary, talking about changing the rules that we have for wage setting. Yes, it's not good to have negative wages growth, which we've got at the moment, but it is part of that, medicine we have to take because of all the paying forward we had during COVID. And we're doing particularly well, as the data clearly shows, compared to other countries. So, let's not start fiddling, too early in this scenario, because obviously people are complaining about, their declining purchasing power. And it's, unionised labour that's obviously in a position to be able to take advantage of this. But if it's going to continue to push up prices, what's the point? Now, the end game to this, unfortunately, Rich, is that when you do get, when you do get this, lurching forward to offset income and then prices, is that those on the labour side of the equation are saying, well, we've got to stop prices rising because the higher wages will work their way into higher prices, as we discussed before. And then it goes on. And then it becomes a very serious economic, problem. Not that it's not reasonably serious now, but then you start getting the chance of let's, freeze prices. And we've already seen some parts of the political spectrum, not surprisingly, looking for some air, talking about freezing rents.
It's the worst possible policy. Absolutely ridiculous.
You can't do it anyway.
No.
But you can't do it anyway. We're moving into a sort of a command economy. It's like this is what they do in China, guys. But it's, as I said, it's you're starting to do these things. I mean, if it results in higher inflation, well, you know who to blame. If it results in higher rents, you know who to blame. And you just take that into consideration when you go to the ballot box. That's the political reality of, the whole situation. But certainly, with a very tight rental market, rents for units in Brisbane are going through the roof. So houses are also rising strongly. And, Brisbane has a very low unemployment rate. So people then who are faced with higher costs will, naturally work towards offsetting higher costs with either a claim for higher wages or pushing up rents.
Right. Excellent answer. Mark is asking, is now a good time to invest in Perth? What do you think about the Perth market, Andrew, its prospects?
Well, the Perth market's very stable. Rich, it came through a very, a period of underperformance. When everybody else was booming, it was going nowhere. And that's because it had a very strong period during its mining boom environment. A lot of that was driven by the fly-in, fly-outs. They flew in, flew out, never flew back in again when the mining boom ended. So there was a lot of demand taken out of the housing market because that was temporary accommodation that was provided for the fly-in, fly-outs. So it took some time to recover. But on the numbers, the Perth market still appeals as being potentially, one of Australia's strongest housing markets. It's the most affordable housing market of the major capitals, which is, remarkable given it has the highest incomes and it has such a very, very strong economy. So, it's not necessary that we're going to go back. Perth's not going to go back to the position where it had house prices as high as Sydney, as it did in 2007. So you never sort of really catch up once you've gone through a significant period of underperformance. But the positives are all there for the Perth market. And one of the interesting things that saw the Perth market starting to rise at the end of last year and into this year, Rich, was actually migration. And I think there was part of the COVID factor that drove Perth. I think Perth is a very good proposition going forward. It has a low entry point in terms of its prices. And of course, it has a higher yield, with its rents. So I think Perth is a good proposition. Yeah. I'm not suggesting there's going to be a boom in Perth, but I think that it's quite a steady market, given the fact that it's really hit the bottom in terms of its prices. And it's no doubt it's starting to rise again now. Yeah. And all the other factors are very positive for Perth.
Yeah, okay. My little caveat to that would be, I think Perth's definitely got some upside. My only caveat would be, just in terms of its link to the commodity cycle. I find that the capital growth prospects of Perth is very much tied significantly to where the commodity cycle is going. And the migration is good, but not as good, I feel, as Melbourne or some of the other capital cities like Brisbane as well.
Yeah, absolutely.
Sorry, Andrew?
No, I'm saying absolutely. I mean, I think Perth is a steady proposition. in that sense.
Yeah.
But and as I say, I don't think it's going to boom anytime soon. So it's not going to have the lows or the highs.
Yeah.
That some of the other markets will have.
So for me, for me personally, if I had to choose between Perth or another capital city at the moment, I'd be putting my money into Brisbane because I think it's got more, it's still very affordable, but also got very, very good upside from a whole range of other drivers apart from just a commodity cycle. I guess it also related to that question, is now a good time to invest full stop, or is now a good time to buy, Andrew? You know, we get asked this question every day of the week. Should I buy now, or should I buy in October, or should I buy next year? You know, I'd appreciate what your thoughts are on potentially how buyers should be thinking about their psychology. I mean, you've outlined some wonderful thoughts about insights into the economy, which I hope the listeners will take home. But what's your thoughts or any advice to a potential buyer out there?
Well, it's the same old story, isn't it, Rich? When we're in a correction environment, you know, it's like, you know, we can look back now and say, well, maybe we overspent during COVID, right? And it's all pretty logical. Yeah, it was always going to create inflation. But at the time, we didn't know. And it's always that unknown, you know, sort of mindset that tends to feed the negative rather than the positive. And that's what happens in our housing markets. But as I said, we've only had 3 years since 1987 where house prices have fallen nationally, and that's and the worst was 5.5%. And yet, even with a strong decline in Melbourne and in Sydney and a moderate decline in Melbourne this year, we're only going to see around a 4% decline in the national house price. Now, what I'm saying is that anything to do with property is not a short-term decision. I mean, people got to just sort of think clearly here. How long, if you're buying as an owner occupier, how long are you going to live in this house? Well, you're probably going to live in this house 10 years minimum, right? So you're not even going to think about the ups and downs of the market in a year's time, much less 10 years time. And if you're an investor, it's a similar position. You don't buy and sell. This isn't a stock option. It's not something you're going to trade overnight from one to another. You know, this is something you'll hold for the longer term. And initially you'll give someone a lease anyway. So, and you've got to offer a vacant possession if you start trading, or if you hold without a tenant, then you're losing income. This is a medium to longer term journey. So the shorter term machinations of the market are reasonably irrelevant. You look at the long-term history, and the long-term history is very positive. Now, for an investor in this market, you are going to get rents like you've never seen before. And the point is, you know, well, we have got record rents. And the point is also that because, you know, we have lower prices, you're also going to get higher yields. So, you know, and then you can start your investment journey from a position of having, you know, a commodity that is in such short supply that the actual returns are skyrocketing in an inflationary environment, you know, above the inflation rate at the moment. Yeah. So I think you just got to take the big picture here, and then it becomes your individual choices, which city, which house, a unit, you know, then you're guided by people on the ground like Rich, or your own personal preferences, right? But the big picture is, you know, imagine people thinking back in 2019 when everybody was predicting at the beginning of that year, well, not me, at the end of 2018, they were all predicting house prices were going to crash by 40%. One guy was predicting. But imagine if you had thought, no, that's it, I'm not doing anything, I'm just sitting this one out, right? We just saw 40% increase in Brisbane house prices over the last 4 years. That's 10% per year, right? And we went through, you know, an extraordinary, you know, COVID period, a pandemic, and we still had our prices increased by 40%. And when we look at our total national picture economically, we're doing better than anybody else. Why should we be surprised? Because we did better than everybody else during COVID, right? It's just reinforcing that. Are we the lucky country? Is it good policy? Is it good management? Who knows? But it's certainly working. And we've shown quite clearly that this country has run out of houses, right? And you just don't add water and there's another 1,000, 10,000, 50,000 houses for all the migrants to live in, right? And there's no way knowing that's going to stop. It's just really, you know, people have got to live somewhere, and we've got 3% unemployment, plenty of jobs, people are getting big pay rises. And that's why I think the markets are starting to turn a little earlier, because people are saying, what's all this doom and gloom rubbish, right? I'm got a great job. You know, people are ringing me up every day. Come and work for me. I'll give you an extra 20 grand, you know, blah, blah, blah. Yeah, I'm going to go out and find myself a bigger house somewhere. Beautiful, you know, because it's a good time to buy at the moment. It's just a question of whether I can find that dream home or that dream investment. But if you can, why would you wait?
Well, you raised some really good points, and you talk about the long term and the economic fundamentals. So what I say to people who ask me that question is, what's your borrowing capacity? Because whether the market's up, down, or sideways, if you've got the ability to borrow, that is one of your key drivers to get into the market. And you've got to use it or lose it, because for every 1% increase in interest rates, you're going to be losing potentially 10% borrowing capacity. So by literally sitting on the sidelines and waiting, Andrew, we find that some buyers actually will have themselves priced out of the market because they can't afford to get in. And when they realize, oh, now we're going to jump in, everyone else is thinking the same thing. They follow the herd mentality. They all get in there, and then that'll be putting a floor, and you'll start to see prices rise again. So, you know, for the answer to that question, is now a good time to invest? It's an unequivocal yes, if you buy the right asset in the right location. And that's what we do as buyers agents, bring that level of research to the table. So I guess, look, we've run out of time, Andrew. I want to just say thank you again for your insight.
Been great.
Again, you can look up Andrew on LinkedIn, track his auction clearance rates and his other information. It's wonderful. And if anyone would be interested in finding out more about our buyers agency services, we'll be sending out some more details. We'll send out a copy of the recording so you can watch it again. And for those that missed it, can catch up. But thanks again, Andrew. Really appreciate your insights, and we look forward to connecting again soon.
Yeah, great stuff, Rich. All the very best, and good luck to everybody out there.
Thank you again. Appreciate it. Thanks, Andrew.
Thanks, mate.